I wanted to share this. I shared this with a couple guys, Hamza and John, on our sales call. Okay. So this is the 3-question pain finding setup. You guys see that?
Yes.
Okay, thank you. The 3-question pain finding setup. By the way, that's a closing technique that I just used there. I didn't say anything until someone said something. And I was going to wait. I'm not going to move on until someone says yes or no. So thank you, Laura, because we would have been here like the rest of the time, not saying anything. But so it's amazing. I'm going through my continuing education classes right now, and I'm actually learning something, right? I mean, I always look to learn something from it, but I learned this, and it was like, oh, this is so good. It's the 3-question pain finding setup. And these guys, I'm taking a class on ethics, ethical selling and insurance, because it's a required 3-hour course in the state of Ohio. And so the part that I'm in is pure video too. So I have to go through every video. I can't just copy and paste text and then take the quiz by doing, the find feature on a document, a Word document. So anyway, the 3-question pain setup. This is really cool. I like it. So basically finding pain. And so the way they're doing it is really cool. It's more of the survey concept. So it's when you're sitting down with the client and you say, okay, so let's talk about why I'm here. I'm going to ask you a series of questions. And each question you can answer back with on a scale of 1 to 5. 1 being least and 5 being most. So let's start with the first question. So Joe and Mary, on a scale of 1 to 5, how important is being financially safe and secure to your family? How important is being financially safe and secure to your family? 1 being the least, 5 being the most. And then let them answer the question. Okay. And then what are they going to say? 1? No, they're going to say, yeah, 5. Absolutely 5. All right, cool. Here's the next question. On the same scale, how financially secure do you actually feel right now? You sit there, you let them think about it. Now, there's a reason why you're in the house anyway, right? Because they don't feel financially secure. But I love to in the Sandler world, we call this taking the temperature. So you give them a scale 1 to 5. If they say 5, oh, so you're like totally financially secure. Huh. I'm confused. Why am I here then? You see how it just prompts you to ask more questions, which is really what you want to do when you're finding pain. What they say, well, I'm a 3, I'm a 4. Oh, okay. Wow, you're 3 or 4. Okay, fair enough. Actually, from that second, let me back up. 3 or 4. So, wow. So it sounds to me like, there are some things that you need to shore up. And here's a great question you can answer as following. So tell me, what would it take to get you to a 5? What's missing right now that you need in order to get you to a 5? And this is where you kind of really can drill, right? And then here's the third question. Now, again, scale 1 to 5, how able would you be to meet your financial obligations if 1/3 or more of your income stopped suddenly and permanently? So notice 1/3 or more. So this is where you can talk about disability. We obviously talk about life insurance, scale 1 to 5. Wow, that would be a 3. Again, you want to find out where they are, and then how do we get you to a 5? So basically what you're asking them is, tell me how to close you, Mr. Client. Tell me what you need, but let's define it. And this is just a great way to get into pain finding questions. On the same scale, how would you be able to meet your financial obligations if 1/3 or more of your income stops suddenly and permanently. 5, would you be able to meet your financial obligation, or is it 1 or 2? Right. So this really kind of gets to the crux of the matter, and nothing is obvious. Here's the one thing: is never assume the answer to a question. Always ask the question, even though it may seem obvious. A question, it's never obvious. It doesn't become obvious until they articulate it out of their own mouth. See, in pain finding, you cannot put words in their mouth. That's what a lot of agents do. So you probably, Joe, you probably wouldn't be very financially secure, right? If you died right now and, you marry and the kids will have to fend for themselves, you probably, it's like, dude, don't ever do that to anyone. Because number one, they don't appreciate you putting words in their mouth. They don't appreciate you making all these assumptions. Here's the key when you're sitting down with anybody is people want to sing their song. People have a song to sing. You want them to sing their pain song to you. And so by prompting them to say the stuff that they need to say, number one, they don't object to anything that comes out of their own mouth. They have to decide when you're telling them stuff if they should believe you or not. And a lot of times they're trying to think of objections against what you're trying to say. But when you can coax them out of their mouths what they want, what they need, their problems, they never object to what they say, right? So this is your control. This is your power that you have in the home when you're working with clients and trying to deal with the pain finding. Pain finding is the most important, is equal to bond and rapport. Bond and rapport, pain finding are up there. In fact, the reason why you don't close a sale is because of bond and rapport and pain finding. Those are the highest, the number one, number two reasons why you won't take care of a client, right? Bond and rapport and pain finding. Does that make sense, gang? I thought this was brilliant. So this is what I'm going to try to incorporate in my pain finding teachings, because those questions just walk them down the road. So does anyone have any questions on that at all, or comments, or have you used something similar to that when you're talking to clients? Quiet.
Well, I saw that you're talking income versus, it's kind of a different pool of money, I guess. You're talking more about the income replacement rather than assets, I guess. As far as, bank account. And I know they're kind of one and the same, but not really. If you got an income source that dries up, and we're talking
Yeah. Well, we're
selling
talking.
it. Yeah.
Well, whatever that conjures up for them. They're the
Right.
ones that have the need. We're just trying to explore what that is, right?
Right. Okay. I was just thinking versus an income, like you said, direct um, disability income product versus an insurance, life insurance product. So could you replace, the wording as far as how would you word it for an insurance product sale? Rather than an income replacement.
Well, to me, the conversation brings up, you're presupposing a solution, like you're trying to pigeonhole someone into a solution when this opens up whatever the conversation leads us to, So, if you're not health licensed, well, you can't sell them disability. So, that's bad on you, right? You can't do that. So you have to refer it to me. No, but when you say if they become disabled, like if 1/3 or more of your income stops suddenly and permanently, household income, it could be household income. I don't know. It's whatever, what does that question evoke in the person? Like what you're thinking is, well, what if it is disability? Well, what if it is? Can you sell them, Bruce, a disability product? If they say, well, if I become hurt and can't work, do you got something that can, kind of shore up the income for that?
Yeah. Yeah. Sure.
Okay. So you can, right?
Yeah. Yeah.
Okay. So
Absolutely.
you can have a conversation with them about that.
Yeah. Yeah.
Oh.
Yeah. The Mutual of Omaha disability income product for sure.
Yeah.
Oh,
So
yeah.
again, it really is whatever their
Right.
pain is, right?
Right.
Now we came in there for because it's either a final expense, mortgage
Right. Yeah,
protection,
right.
lead,
That's right.
but it opens it up to, things that they're concerned about. And a question like that would say, well, I really want to make sure my home's protected so that, my family doesn't have to worry about the mortgage payment. Okay, cool. So tell me what happens if, when you die, you don't have this in place. So what happens to your family? What do they do? Right. Then that leads to the next question. Well, I don't know. That's why I want to get paid off. Well, let's take a scenario. Let's say I present you options and you say you want to think about it and you don't take care of it today. And then you die tomorrow. You have a heart attack in the morning. You're no longer going to be able to provide for your family. So tell me what happens. What does your wife, Mary, have to do with her 3 kids in order to make that payment? And you're nice, you're smiling. Well, that's kind of that's a hard question. You're not paid to ask softball wussy ass questions. I'm sorry. Softball questions. You're there to ask the hard questions for them to answer. Right. So to answer the hard question, well, she'll make the mortgage payment probably out of our savings. Oh, okay. So how long can she make mortgage payments out of your savings? Like 24 months? Like what is your mortgage payment? Ballpark me a mortgage payment, $3,000. So let's say the next 24 months, what would that be? 36, $75,000 you have in your savings account that may cover the next few years. It's a question. Well, they wouldn't be able to do that. Okay, so the month that they can't make the mortgage payment, how long before the bank decides to take the house back and forecloses? Tough question, huh? Yeah. How long do you think it would take? 6 months? So the bank, maybe they'll let them stay in for 6 months before they have them move out of the house. So tell me, where would your family move? Would your wife and kids, would they get an apartment? Would they move in with family? You just wait for them to answer the question. You're not piling on questions. You're just asking the next question. The next question is, so they have room, her parents they have room for your, okay. You see how you're drilling. You're making it so uncomfortable for them to even think about scenario of not having this in place, that they are like sick. See, the pain finding process is them realizing they got a problem, and then you rescue them. How do you rescue them? Well, fortunately, Joe and Mary, that's why I'm here. I'm going to make sure that never happens to you because we can take care of this right now. boom, then you're on your way, man. But this is kind of the precursor to all that, is to get the conversation going. So this is one of the ways to get the conversation going. You know, another way to do it is like, okay, so tell me, Joe Mary, why am I here? Why am I here? And what I love about that question is that does not sound like a sales guy question, because the sales guy would go right into selling them product and solutions. No, right? I start from the very basic. So tell me, why am I here? And I just shut up and I let them tell me why I'm there. You know, I'm not there to waste my time. So that is definitely a Sandler way to get into it. But you got to make that transition, right? It's the transition into the conversation, and then just drilling until the pain, you can feel the tension is so unbearable from an emotional standpoint that you can let them off the hook by telling them, well, that's why I'm here. So you become the hero because you're the one that releases the pressure and gets them moving forward. Because all we're really wanting them to do is let's move forward to take care of this, right? So does that make sense? Anyone have any other questions?
I guess mine would be more of a product question because I haven't studied them, but like the difference between like a mortgage protection and life insurance would be that the mortgage protection also covers disability, or like if they're not able to have the mortgage, or like why would mortgage be better than just life insurance for someone to like pay their mortgage?
Yeah, that's a great fundamental question. So the feature of the mortgage protection policy is that it's designed to be a marketing niche that they can get into without taking a blood and urine test. In their mind, it covers their mortgage because it can cover their mortgage, but it doesn't have to be their mortgage. It's not tied to their mortgage, in other words, but it's, you know, what they sit down with us because they're looking to protect their, you know, $350,000 home. And so we walk in there, we've got mortgage protection. They typically answer a mortgage protection needs. So we're going to sit down and talk to them about mortgage protection, life insurance, which are these particular type of term products that we can cover them without getting a blood and urine test. It'll go typically for as long as whatever mortgage they have, 30 years, depending on their age, right? And there are features in it that make it different than the other type of credit life insurance that they can get with their mortgage. So they can keep their mortgage, they can change their mortgage, they can refinance, and this program will stay with them, not the house. So it's portable. We call it portability. So it'll go with them. And if they move into a bigger home, then we just cover the remainder of whatever mortgage obligation they have after this policy pays off. You know, if they need another 100,000, we just write it for 100,000 because the other policy will be in force. You know, so and so that's kind of the features of mortgage protection. Some mortgage products have disability rider in it. Some don't. Life insurance typically won't have disability riders in them, embedded in them as a rider. Mortgage protection, you know, typically certain mortgage protection products, depending on the company, will have them. Some mortgage protection products with other carriers do not. And so here's the thing. The reason why I go into why mortgage protection is different is that it's all life insurance, right? It's all life insurance because it insures their life, but it's a niche called mortgage protection. And this is why it needs to be a niche in your mind, right? In our minds, is because when you encounter the objection on the phone or in the home, well, isn't this just life insurance? So you're going to have people say, well, isn't this just life insurance? You know, I already have $1 million policy. Isn't this just life insurance? And so our answer is no, this is mortgage protection insurance. Mortgage protection covers one of your largest obligations, your home, life insurance covers income replacement. See, so what we've done is we call it framing. So we frame the objection that mortgage protection covers a mortgage, but life insurance protects the income. Okay. And then they go, oh, okay. Well, what's the difference? Mortgage protection will cover your mortgage obligation so that your life insurance can cover your income protection. Like, how many children do you have? 3 kids? Okay. And I presume you probably want to make sure that part of that life insurance covers your kid's college if you're not around to pay for it, right? Again, question. Well, yeah. So let's just say, for example, how old is your oldest child? 13. So in 5 years, you're going to have to start thinking about college. So what does a decent college cost these days? 25,000 a year, 50,000 a year. What do you want to go to, a good college, a great college, or, community college? What's someone going to say? Well, I want to go to a good college. Okay, what's a good college cost these days? Like, I personally know, right? Really good colleges, you're in the 40, 50,000 a year range. If you want to go to mediocre, I'm just going to mediocre college, maybe you're talking about 15,000 a year, whatever it is. I don't care what it is. They tell me what it is. Well, I don't know, 25,000 a year. Well, they see something absurd like, well, I think so tell me what you think is a good college. Duke University. That's more like 50,000 a year plus 60,000 a year, right? Anyway, whatever it is, let's just say it's 30,000 a year. It's about 30,000 a year. Okay. So 30,000 times 4 years, what's that? 120,000 times 3 kids. That's 360,000 of the million. And about how much do you make? Just ballpark, round numbers. 125,000 a year. Okay. So you take, 360,000 off a million. So what is that? 640,000. And so you're 120,000. So you're giving your wife income replacement for about 5 years or so. Is that fair to say? So do you think within 5 years, your wife could kind of figure out how to make up the difference, or will she learn how to live on less? Or, what are you thinking with that $1 million? You just shut up. You shut the heck up. Because right now, their $350,000 mortgage, it can't be covered with their $1 million policy. People think $1 million, I got a plan. Man, seriously, you get them spending that $1 million. Oh, by the way, do you have more mortgages on your cars? There's some car loans are mortgages, literally. But so you have debts, right? I'm sure you have probably credit card, maybe your auto loans and stuff. You see what I'm saying? All of a sudden, life insurance becomes income protection. They can't afford to cover their home with it. So mortgage protection handles the home. So you see how in their minds, you've just separated the need and you have a chance to get in the home. So does that make sense, Laura?
Yeah, that was super helpful.
Once you get a life insurance license, then if you get a life insurance license, it'll be a little bit more makes sense.
I'm halfway through now.
Especially when you're on the phone with someone and they give you that objection. Isn't this life insurance? Well, now you know how to handle it. Right? So good question. Anyway, we're end of our hour, but thanks everybody for plugging in. Appreciate it. And great question. And I had some chats. It's good. One protects your income, the other protects your equity. Yeah, equity protection. Because it is, think about it. They'll foreclose on your home even if you have equity in it, and they're not going to give that equity back. So, protecting your equity is another way to talk about, because if they, 20 years from now, how much equity do you think you'll have in your home? This will make sure that all that equity is protected for your family. Then they could take that equity out, put a down payment on another house that is affordable in your wife's income. So that's another way. So thank you, Jer. Appreciate. Yeah, cool. All right, man. Thanks, everybody. God bless. I appreciate y'all. And again, think about giving. Give more, and God will bless you with more. So rock on. See ya.